private equity, private credit, and real asset strategies are part of your growth plan, you need to be at RIA Edge Private Markets, a one-day high-impact event built exclusively for senior-level RIAs, family offices, and allocators. Join us on December 4th in New York City. For more information, visit informaconnect.com/RIA-edge-private-markets. That's informaconnect.com/RIA-edge-private-markets.
Hello, and welcome to another episode of Wealth Management Invest. I am your host, David Bodamer, with the wealthmanagement.com editorial team. For this episode, I'm excited to bring on a pair of guests from AllianceBernstein. We have with us Onur Erzan and Noel Archard. Rather than going through their titles, I'm just going to allow them both to talk a bit about, to talk about Bernstein, and then also if you guys can just talk about your roles. But maybe we'll start with Onur if you can get us going.
Hi, David. Thanks for the opportunity. My name is Onur Erzan. I wear three hats at AllianceBernstein. I'm responsible for our distribution function at the asset manager, so run distribution globally for the firm. I'm responsible for our private wealth business as well as our private alts platform.
Great. Noel?
Great. Thanks so much. Appreciate the opportunity to talk. And Noel Archard, I head up our global ETF and Portfolio Solutions team. So our focus is really on both the growth of our ETF business from a strategic perspective, as well as our SMAs and model business, how all of those intersect, sort of the vehicle strategy that goes along with the investment strategy, and then the solutions, how do we bring that client experience into the.
So maybe we could talk with, I think we're right around the 3-year mark of the firm launching ETFs. And at this point, I think you have almost 20 that are in the market. So maybe if you could just talk a little bit about what it's been like to build that business out, what some of the strategy has been around how you've selected the funds that you've launched and what some of the uptake has been.
Sure. I'll go first on that. And Onur, please chime in if there's anything you want to add. But yeah, we've got 19 ETFs at this point with just under $9 billion in AUM. We just hit our 3-year mark this September, just this month. So we launched our first two in September of 22. And the way that we thought about it then and the way we continue to think about it is just how do we make sure that we are meeting the clients where they are, that we're bringing products to market, ETFs to market that reflect the strength of our strategies, that give them the choice of the wrapper that makes the best sense for their business lines. And also to think about just how do most clients use ETFs in portfolio construction. So either we used our ETFs to fill a gap that we might have in the lineup, or to enhance or complement strategies that we already have. So either take an existing strategy that might have been global, multi-sector, break it down into a domestic offering and an international offering to make them very model friendly for the asset allocators and the strategists out there that are building ETF driven models, and just for investment purposes, making products that could either be a long-term investment tool or a short-term liquidity buffer for the portfolio.
Onur, did you want to add anything?
No, summarized it very well. Obviously, we have been in asset management for decades, and ETFs is an extension of our heritage and tradition as an active manager. So it's another tool in our toolbox to deliver those investment capabilities to our clients in liquid, transparent, and tax-efficient ways. So that's how the idea came about, and these 19 are the first waves in the first 3 years to serve the specific needs that Noel articulated very well.
And what are they all active ETFs, or is it a mix of active and passive?
All 19 are transparent active ETFs. I think within our retail sphere, the active, our brand is very recognized as an active brand, and that's where the strength of the strategies lay. So we decided, that was a space where we thought we could be additive. There's obviously a lot of choices in the passive ETF universe, and we wanted to come in and make sure that we were bringing in something that would work with the passive products that were already on offer.
Yeah, and certainly it's a very active time in general, the market. I mean, I think if you look at launch volumes, I think it's something about 70% or so of ETFs that are launched these days are active strategies. I mean, active is a very big term, though, right? It encompasses a lot of different asset types, strategies, styles. So, what do you make of like the overall market set and like what's going on with the competition and how you kind of, I mean, obviously you've been very successful to get to that kind of AUM in 3 years with what you're doing. So how do you kind of navigate this competitive landscape?
Yeah, it's an incredibly robust landscape, and I think that's great. I mean, it's a great time to be an investor. You have a lot of choices out there, and as you said, this spectrum of active products goes from systematic strategies to the very fundamental strategies. You've got products that use derivatives to arrive at some type of an outcome, whether that's income generation, whether that's some type of buffered return or defined outcome. So there really is a broad spectrum. Our view of this was, where do we think we have capability and credibility and bring those products to market? And so we have a little bit of systematic. We have some that are fundamental. We have some that are products that use derivatives to arrive at an outcome. We've really just tried to be selective about where we think we're going to add value, where we feel like we've got a good opportunity to interact with our clients and help them achieve some end portfolio state that they're going for. Again, in combination with what's already out there. I think it's hard to show up and say, sell everything you have and put our product in instead. You have to be mindful of how portfolios are constructed today, and then how are the products that you're bringing to market working with those constructs.
And I mean, another thing that we hear a lot from advisors at this point is thinking about the number of manager relationships they have, and wanting that to be simplified, wanting to be able to, not necessarily do everything with one, but have a smaller number of relationships to manage, and maybe be able to go to those managers for a nice, and who have a nice menu that they can be picking from. So is that does that align with your experience, and does that fit with what you're trying to do?
Yeah, 100%, David. We see this around the world, definitely in our U.S. business, U.S. retail, which is our largest retail business in the world. And there was a period in the evolution of the industry with the shift towards open architecture. Many firms wanted to have a large number of asset management partners as the industry was adapting to a new model. But if you think about the last decades, both retail platforms as well as institutional investors recognize, yes, they benefit from diversity of choice and having multiple partners, but ultimately there are diminishing returns to having too many partners. And hence, they are consolidating the relationships to strongest and the fittest partners, if you will. And in that journey, they're obviously trying to pick partners that can fill multiple roles in that relationship, in that partnership. Some of it is around the solutions that the firm can provide to fit the investment needs in the portfolios, either as building blocks or different outcomes that Noel very well explained. But also in terms of value-added services, in terms of helping the advisors with their practice management, helping the home offices with portfolio construction and thought leadership. So there's a wide range of things that wealth managers and asset managers partner on. And definitely we are seeing that trend towards many firms want to do more business with less managers.
And on that portfolio construction theme that you just raised, are you seeing anything changing or any specific trends in how, what advisors are looking for? We're here about the fourth quarter of 2025. There's various macro factors at play. Has that factored into, so how is that then now redounding into how advisors are looking at the portfolios they're building for their clients, and maybe changing those mixes? Are you picking up on any interesting trends there?
Yeah, no, absolutely. And Noel can chime in as well. I think there are a lot of interesting shifts in the market. Some of them are cyclical, some of them are structural. So first of all, obviously there's been a tremendous adoption of private alternatives in the retail channels over the last several years. So we definitely see that only accelerating with the semi-liquid vehicles and interval funds, particularly. So that's a big trend, and more advisors are basically incorporating private strategies for diversification, in certain cases for further return capture in their portfolios. That continues. In terms of that's probably structural with the development of the private markets. Obviously, more companies are staying private for longer. Private credit became a much more dominant financing tool in the broader financial services. So those are structural shifts. On the cyclical side, obviously, we have seen dollar depreciate quite a bit. A lot of international markets in equities were out of favor, given the U.S. equity markets really dominated, particularly with the continued strength of technology and AI stocks, as well as the broader appreciation of the equity markets. But now there is a little bit more interest in non-U.S. markets, given potential risk of dollar depreciating more, and more investors are picking up interest in terms of diversification in their international through their international equity exposure. That's definitely another trend that we are seeing. And then finally, the market run-up has been very impressive. If you think about all the major indices in the US, pick your favorites. And some of the clients are becoming more risk averse or cautious. Advisors want to be responsive to their clients' needs and preference. And hence, we are definitely seeing at least some tactical adjustments for instance, protection. Noel mentioned some of the buffered strategies as an example. So definitely we are seeing all those different structural and cyclical trends play out. But Noel, what would you add?
The only thing that I would add to that, I absolutely agree with the larger trends that you highlighted. Another area of growth or where we're seeing some shifting is growth of separately managed accounts, which is part of a larger trend that I would say is a focus on after-tax returns, and how are you either minimizing your capital gain tax that you have to deal with at the end of the year, or in some cases, how do you mitigate even some of your income tax generation? So I think a combination, I talked earlier about vehicle strategies and how that starts to play out. And when you think about the role of SMAs, when you think about the role of ETFs within a portfolio, both bring a different flavor to that after-tax return strategy. And we're seeing that just rise more and more to the fore as these products become more and more accessible.
Right. Yeah. There's a lot of now threads I could potentially tug on here. So I have to figure out which ones we can get to. But like, maybe we could just start with what you just ended with, because I think the SMA thing is very interesting, right? Because one of the elements here is that they I think, as you were just alluding to, are available to investors who would not have had access in the past because of tech changes, or just ways that you can, the cost of managing them. So now you can actually, like, something that may have only been available to high net worth can actually come a little bit further down into the wealth stack. Is that right?
Absolutely. It's becoming a much more accessible offering. And I think, when you think about equity minimums, that can be at the, $150,000 mark, fixed income minimums slightly above that. We've got completion funds that can help round out the offering that you see more and more firms coming out with those. So again, it's a little bit of a mix and match. There's not one size fits all, but you can use SMA portfolios to such great effect, whether that's for a broader offering of both fixed income and equity, whether that's a balanced approach to try and manage your cash flows to the most effective after-tax return, or whether that's a muni sleeve to have an additional focus there. We continue to see growing participation in that as I said, as the products become more accessible to a wider group of investors.
And I think there's even talk of including alts and like UMAs, right? Like, so that you can have like all of your assets in one account.
Yeah. Again, the technology, the expansion, when you think about a UMA, and this is again where I say I don't think one size fits all. This is the one of the things that attracted me to AB. was sort of the breadth of the offering, both in the U.S. and abroad, and sort of the number of teams that are in play. It's a nice problem to have when you've got more products that you could probably bring to market than you want to bring at any one point, to make sure you're not flooding the system. But the combination of an SMA to capture a particular part of your muni portfolio, some active ETFs as a completion strategy potentially, and then an interval fund, alongside that to give you your alternative exposure. That's a pretty robust portfolio that's available, to investors today that wasn't there 5 years ago.
And I guess, well, one of the potential questions though that can raise is, does that get too complicated or for an investor to think about? So how do you then do the education piece to make sure that advisors and clients understand the benefits of these structures and why they should be doing them, and why and why this is the way the market is moving?
Yeah, I mean, great point. Ultimately, it's a transition and change in the portfolio construction philosophy, right? For many years, everybody was pretty conditioned on the traditional 60-40. All of a sudden, now you're introducing alternatives into the mix. And there's definitely, like any other trend, at times there's a proliferation of product as well. So you need to be careful and go for the quality. Ultimately, the way we kind of work with our advisor partners and our distribution partners is really on 2-3 levels. One, really kind of starting with the more foundation, why and how private alternatives can enhance the portfolio outcomes for different types of clients, whether it's the more affluent clients or high net worth or ultra net worth clients. So it really starts with that. So what's the purpose? Then second, the education goes to more technical areas of the product, right? So you need to definitely understand the different product characteristics, liquidity profile, administrative side of things in terms of capital calls, if it's not a evergreen product, but a more drawdown kind of style fund. And then also understanding even the different tax implications with also the tax filing, if it's a K1 product versus a 1099. So those are all product level details that that advisors and firms need to fully understand and incorporate into their practices, their processes. And then finally, the ongoing, I would say, servicing and thought leadership. Obviously, these alternatives asset classes are tied to the economy in different ways, and really helping the advisors and home offices kind of benefit from our research and insights in terms of what's happening, for instance, in the private credit platforms. In our case, we manage over $70 billion in private credit, and we touch the credit ecosystem in many different ways. So we always try to bring that holistic view in terms of what's happening in credit markets and what are the ways that private credit might be an enhancer to portfolios, both in relationship to equities as well as traditional fixed income.
And do you have thoughts on where we might be going in terms of, like, from the 60-40 portfolio to, I think I've heard lots of different potentialities thrown out, 50-30-20, or maybe just 10 in alts. Do you have like a feeling on what and obviously, there's not one number for every client. We know that, like, people's mixes are going to depend highly on where they are in their careers or their lives, what their risk tolerances are, et cetera. But just, on the balance, is there a thought on like what the proper alts allocation or what average alt allocations might be going to?
Yeah, look, Noel would have his perspectives as well. From my perspective, I don't think there's any magic number, if you will. Obviously, I think the first kind of stop from an overall industry perspective is going to be 10%, given we are still starting from low single digits in terms of penetration of alternatives in client portfolios. And then maybe over time, it might get to 20% if I approach it more from an aggregate industry perspective. In terms of individual portfolios, I mean, as you mentioned, David, it depends on so many different things: your risk appetite, wealth level, your goals. I mean, in a trust account, if your idea is long-term investing, you might go much heavier into alternatives. If it's more your short-term to medium-term portfolios, obviously given the liquidity constraints and all that, maybe it's a much smaller single-digit allocation with a heavy focus towards semi-liquid products. And then there are in-betweens in terms of your retirement assets, et cetera. But in our experience, depending on the client, the typical range you look at for affluent and above clients is in the 10 to 30%. And then finally, with the adoption of alternatives into DC plans, obviously that's another area or vector for expansion. As we know, defined contribution plans is another big kind of saving vehicle, not only for the affluent and above, but also for the mass market. So that's going to, I think, create an expansion of the alternatives allocation for mass clients for their retirement savings as well.
Yeah, that's certainly going to be interesting to watch to see how that unfolds. I think we've already got a couple of folks talking about like target date fund or CIT products that are in development, whatever. We see what happened with the administration, but certainly it's going to be interesting to watch to see what happens in the 401k space with alternatives.
And the nice thing on that is obviously, as Onur said, then you take that holistic approach to the portfolio. So where, in your retirement portfolio, you might have a much longer time horizon before you're going to think about touching that. It's a great place for these less, what might be, less liquid offerings or part of a fund, and then look at your other, your sort of non-shielded or non-qualified assets as your different liquidity pool or growth pool. So I think having that holistic portfolio view is really going to drive that use case.
So another thing I want to jump back to was you talked a bit, I think, Onur, you talked a bit about the international markets, and was curious if in the cycling back to that, if that's developed, emerging, a mix of both, or where is the play in international, right? That folks are pursuing?
Yeah, it's a little bit of both. I think, as I mentioned, the key driver of interest for investors in the U.S. and overseas is obviously the great run of the U.S. equity markets and the indices climbing to very kind of high levels. So that obviously made some of the portfolios to be even more allocated to U.S. equities. And if you look at the MSCI, I think U.S. equities makes up 70% of the index. So there is definitely some heavy concentration. And then on top of that, with the uncertainty around the impact of the tariff policies and some of the broader macro trends, the dollar has depreciated. So others are looking to access maybe other currencies to enhance the diversification in their equity portfolios. In terms of developed versus emerging, I mean, developed, definitely we have seen an uptick in interest in Japan. Japan has gone through some governance and other improvements, and the inflation is at a healthier level in the economy. So there are a bunch of drivers of that, and the local indices did much better lately. So that's an example of a developed market where there has been continued interest. And then on the emerging market side, some of it is, I would say, more relative value compared to their developed market peers. Emerging markets companies are trading at pretty low levels, and that's piquing some interest. And then talking to investors around the world, there are also certain economies that might benefit from a commodity cycle as well. Typically, the commodity cycle benefits certain emerging economies depending on their natural resources. So those are several things that are happening around the world that might pique interest for international equities, and hence we were also pivoting some of our product launches when it comes to our ETF lineup to get into those growth opportunities globally as well as regionally.
And then one other one I wanted to jump back to was the world of the defined outcome ETFs, because that's also been a really buzzy space, a lot of product development, a lot of fund flows, a lot of different strategies around, all the different flavors of those things. So if you could just like talk a bit more about what you've been seeing there.
I think that's, when you think about the flows into active or passive ETFs, they're fairly on par relative to, how much is going into equity, how much is domestic versus international, what's going into fixed income, and the various cuts there. The one outlier in the active ETF space really is that sort of derivative based or defined outcome type product set, which again 5 years ago was fairly small relative to the very large pool of assets, over $11 trillion, $12 trillion in ETF assets. It made up a pretty small portion, but that has really been growing in a healthy manner since 2020. No big surprise, sort of with the return of volatility. There's a little bit more consideration of, is there a way to dial in some of the portfolio outcomes, maybe in a more targeted fashion, especially if you're trying to reduce drawdowns ahead of key life events. You don't always want to experience that, 10, 15% market dip the year that you retire. Is there a way to mitigate that in a more precise way? So we're continuing to see a lot of interest in those types of products. We're continuing to see broader adoption of those products. I think there's still a learning curve that folks have to go through. Again, whether these are products with a terminal date, whether they're evergreen products, and how do those two fit into the portfolio, and how can you use them to best effect? So I think that the industry has been picking that up, and then working with the distribution platforms to think about good ways to go out there and promote the appropriate use of the products.
Right. I think the word derivatives probably scares some people. So when you start talking about like options overlays on these things, that's an education point, or just even I think getting your head around the idea of principal protection or floors or buffers. There's just a lot of terminology that comes into play, and I feel like whenever that starts happening, right, some people just get nervous about these things. But when you understand the products, I think they have a value proposition that they are and they are delivering on. I think there's a lot of studies that have shown that these have performed. They are doing what they're supposed to do, and there's even with some skepticism in the market, they seem like they've um, you know they're doing what they're supposed to do.
Yeah, I think you put your finger on it. I mean, when you think about how the underlying works, if you're not used to dealing with options or option strategies or different forms of derivatives, it is a bit much to take in at first. But what I've liked about these products is that, to a great degree, it's math. I mean, sort of the derivatives market's very formulaic, and these are sort of option strategies that have existed for a long time and have been utilized by a fairly small group of people who get comfortable with how they operate and sort of what the risk return aspects are of the strategies. Folding them into that ETF construct again just makes them more accessible to a greater amount of people. So again, it's on us as an industry to explain what your profile is depending on when you buy into the product. But once you sort of get your head around that, it sort of reduces a little bit of the surprise element, because again, it's fairly mathematical. If the market does X, the product does Y.
Right. Well, sorry, did you want to add anything, Onur?
Yeah, I mean, the other thing I would add is, I mean, this is one area obviously financial advisors can add a lot of value for the clients that work with a financial advisor. I think financial advisor can definitely help with that navigation of the landscape. There are different flavors of these products, and finding the best solution for their clients. So I definitely see those as a way to engage with the clients, and definitely an important solution for the financial advisors in their toolbox.
So we've been talking for a good chunk here. So you've been very generous with your time. I guess two last things. One is there anything that that I haven't asked about, or anything that you would like to just highlight as a particular takeaways for the audience?
I think we covered it. I think in our experience, in our private wealth business, in our asset management business, we see three kind of major trends that we covered. I think in summary, definitely there are very effective tools like SMAs, ETFs to bring that tax efficiency and personalization, depending on the solution, to portfolios. So definitely that's an area that is an important area for the advisors to embrace and incorporate into their client engagement and dialogue. Second, we touched on it. There's a great amount of innovation in terms of the alternatives area. Obviously, caution is necessary, like anything that is growing very fast. But ultimately, there is, in our view, a role for private alternatives, particularly private credit, based on our experience in client portfolios. And there are different ways to access it. The key is education and making sure advisors help their clients find the right wrappers and the right allocations for the client portfolios, depending on risk appetite, liquidity, etc. And then finally, the good old diversification is never an old story. It's always here. Obviously, alternatives is one way to do it, but also more broadly, international exposure might be even more relevant. Even some other alternative asset classes as well. So diversification is key.
Great. And if folks have more questions or if they want to get in touch, where should they go?
Best place to go is the website, abfunds.com, which will give you access both to the insights, sort of our market insights and views on what's going on across the economy, as well as the full range of products to review.
Great. Well, Noel and Onur, thank you so much for your time and for answering my questions.
Thank you very much.
David, can you tell people how they can get in touch with you if they have more questions?
Yeah, you can always find us at wealthmanagement.com. The investment section is where all of our coverage of these types of topics lies. And then you can also find me on LinkedIn.
All right. Well, thanks to all of you. And thank you for listening today. Please like, follow, and share this podcast with your friends. Till next time, I'm Wendy McConnell.
If private equity, private credit, and real asset strategies are part of your growth plan, you need to be at RIA Edge Private Markets, a one-day high-impact event built exclusively for senior-level RIAs, family offices, and allocators. Join us on December 4th in New York City. For more information, visit informaconnect.com/RIA-edge-private-markets. That's informaconnect.com/RIA-edge-private-markets.